All right, guys, welcome to already day 12 of Anomaly's sequence. Today, we're going to be going over quite an important lesson. We're going to be going over pretty much the technical representation of running liquidity and what you can anticipate afterwards. This is a very, very important lesson. This is lots of technical terminology, kind of giving you guys 2 videos this week with new technical understanding where we're going to be tying lots of concepts together. We're going to be tying concepts of, preferences, pretty much what we talked about yesterday as well when it comes to the 3 type of playbooks that you can kind of entail of how price moves. We're going to be doing all of those things and we're going to be adding them all in here. Before we go into the logic lesson tomorrow and the psychology lesson Friday and a little bit of price action potentially on Thursday, I want to make sure that you guys understand this because this is pretty much just your main concept. So it's running liquidity. You guys might already be familiar with my liquidity videos. If not, please do. Feel free to check them out. I go a lot more in depth on the actual market dynamics behind running liquidity and what it entails. But today we're going to be going over the technical aspects of what it means when we're running liquidity on the left, and we're going to be doing this mainly on a visual representation, which is just your line graph, instead of going in some actual candlestick examples before it gets too complicated to understand, because I want you guys to open your pretty much your notebook and write down everything that I'm going to be talking about this time, that you can already kind of predict them on the charts yourself and that you can already understand them before I get to the graphical examples myself, that you actually understand what they look like, what you can do with them, and the different variables that I've mentioned in this specific video that I'm doing right now. So running liquidity pretty much entails one of 2 things. If you're already familiar with my liquidity videos, you know that running liquidity can be done in 2 ways. We can do that when we run a low, or when we run a high, right? In this area on Euro USD, we understand that running this high entails that there's some sort of increase in demand for the dollar above this high. Let me see if I control that a little bit better. Yeah, above this high, so increase in demand for the dollar. Whereas when we're running lows on EU, that means there's an increase of demand for the euro. We're at relatively cheap areas, right? We look at one thing, which is pretty much how price reacts around these levels. So let's just make it super clear. What we're doing here is we're obviously running sell-side liquidity, right? I think that's the most common annotation that you guys understand. And no, it's not stop orders. It's none of that. We are just running sell-side liquidity. And the best way to portray this is that we've gone into an area where there is passive liquidity resting at these levels, and that's pretty much where we are here. On the buy side example, obviously what we're doing is running the opposing, which is BSL, which is going to be buy side liquidity, right? Quite simple. What we're then looking out for, and kind of what already validates one of 2 things, is how price reacts in this area below, right? So this little area is our first area of importance. By doing so, and by understanding what this area could entail, we already kind of add a little bit of logic to our thinking, right? So we want to make sure that in this area right here, we are seeing one of 2 things, right? We are seeing, there are 3 different things that you can see, right? This sell-side liquidity can be what we call a liquidity grab, an LQG, right? Something along those lines. That then gets confirmed if price leaves behind an imbalance and then takes out a swing point right here. Then that sell-side liquidity with the body close above that level becomes a liquidity grab. What can also happen is that we have 2 candles form, one that closes with a body below this and then, comes back up in the next candle, and then an open above that area. Right, you see how we're going into like quite a lot of finer details here. So what we're looking at is specifically pretty much this area right here, right? We're going to kind of portray this as X. And what we want to understand is how price reacts below X, right? So you have different things that you can have here in this distance, or you can have one of 3 things pretty much, right? You can have potential liquidity grab forming, body close, candle body close, and candle body close plus open, all forming under this distance, right? So those are pretty much your three different criteria that you have, vice versa with obviously what you have here on the buy side example, right? When we run buy side liquidity, same, not too difficult. Let me just extend that right here. Like that. Each of these holds different weights, right? If we have, for example, so purely just looking at this close below this sell side liquidity, if we have a candle body close and an open here, that's quite nice, right? There's a little bit of a difference here. So if we have a candle close here on whatever time frame you have, right, whether that's M15, that means that we've transacted and also then somewhat also agreed upon there's feasibility to liquid price action of closing at that level, right? Automatically, what you will get is then one of two things, right? You can have a candle close here, and ideally, you want to see the next one could be completely like wicked. Usually you'll get one of two, but either or, if we have some sort of candle body close, so let's say this bearish candle closing here, that's very, very nice. But you can also obviously have price stagnate here, and then create a bullish, obviously get your close here, get a bullish candle, and then have your next open of your next bullish candle be above that level, right? So that's exactly what I mean. You can also have a close and an open below this level. You can have a close and an open above this level. Either way, if you commence with a candle body close below this level, that is somewhat of less of a good sign if you believe that this is going to be an expansion, right? So we run liquidity, and what we're actually doing is we are transacting at this level, right? So one of two things you got to realize happens at these levels. By doing so, right, if this becomes a wick and we have some sort of candle here, right, price pushes down and then price comes back up, leaving behind some sort of wick in this area, right, that suddenly becomes a little bit more appealing if you want to get involved in this move, right? But at the cost of what, right? At the cost of there not being a lot of body on this candle, right? So you got to understand one of two things, and what you're doing is playing market dynamics here. You're understanding that, hey, when price is aggressive with the pullback above this level, right, above X, you are most likely already seeing, let's say, buyers in this case absorb price up, right? So sell side momentum is trying to push price lower. Sellers are trying to push price lower, 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 lower. Buyers are stepping in and managing to close price above that previous sell side liquidity. You got to ask yourself, what does that actually mean? It means that buyers are not content at closing the market at this level, and that they actually want to step price above these previous areas where price was relatively cheap. So that means that we're tapping into new pools of liquidity here, kind of allowing new buyers to step in, or previous buyers here that didn't manage to get their orders filled, right, in this move here. So that kind of showcases incentive already, that there is buy-side momentum available in this injection right here, right? But at the cost of not creating a raise, right? At the cost of not having a candle close below this area, and at the cost of potentially not creating some sort of, agreement here where price is transactable, and allowing price to potentially, open up. Right? If this is a bearish candle and price closes here, you could get obviously your bullish candle. Let's just quickly change color here. I get a bullish candle as such. Maybe that's not the best way of drawing it. Get a bullish candle, right? If this is bearish, open, high, low, right here at the wick, and then a close here, and then you get a bullish open here, and then price obviously coming like that. What you're missing is, this candle looks a lot nicer to have, right? And then, you could get a new candle like this. struggling here. You could get a new candle like this, right? That could potentially leave behind then your imbalance that you're looking for. And then obviously you can see where this is going, or you could wait for the pullback, enter off of, the OB, mean threshold, imbalance, OT, whatever you want, start adding all your technical terminology in that. So the key thing, what happens is you start first at looking how price runs liquidity. Price will always run liquidity, as we said. Price will always move from areas that are cheap, relatively back expensive, back in cheap, and then you're looking at how price reacts here. That's kind of the first thing at your arsenal. It's the first thing that you start looking at, right? So the first thing in your playbook that you want to have is with old highs, lows, or interim highs, lows, anything with price fractality, is look at how price opens and closes around these levels. At sell side liquidity, at buy side liquidity, at all these things, it is very important for you to understand that these are like the cornerstones of your first thing, of your first, let's say, rule that you can have in your technical understanding of price. Because when price does that, and let's say when price gives you some sort of, let's say, rule book of, okay, we're closing at this level, we are showing some sort of like body close below price, body close below the sell side liquidity, body close above this, it means that there is feasibility to transact there. And then the worst thing that you want to see is a continuation down, obviously, because then you're straying further and further away from the potential for price to actually create that shift. Because we're all very familiar with this level, right? We're all quite familiar with what this level is. Market structure shift, the market shift, the shift, however many letters you want to have. We're all quite familiar with what that means. And that's kind of the danger of, I don't want to step into this understanding too quickly, right? Because I want to give you the understanding that there is so much more to look for first before you blindly just copy some sort of, let's say, market execution pattern with your stuff. Because I can give you this and you're going to be looking at every single time that you see this, you're going to be like, oh, sick, we got some sort of stuff here, we got something here, and boom, you're in a trade with no actual reason, right? So now let's add just this knowledge. So we're going into the market shift, the market structure shift, the shift later. Don't worry about it. That is going to happen. And I'm going to give you the variables for that as well. But let's first talk about the three different ways, right? And combining the three playbook with this, okay? Because this is in essence where your E1 comes from. E1 entails run a liquidity injection play, right? So we run opposing liquidity and then we inject new liquidity. Whereas an E2 is a continuation in liquidity. So you've already got confirmed bias. You already understand that there's some sort of respect happening of current order flow and that you are then continuing that liquidity. Now let's add the three playbooks in here, right? Price goes from arrays to highs and lows, or price goes from highs to lows to arrays. Right, let's just kind of put these two together for now and talk about kind of probability here, right? If you understand this and you kind of look at the differences, you will quickly understand which ones are more preference in what scenario. So when we have, let's say, in this case, we have an array here. This could be H1, H1, and this could be H4, like that, right? Quite simple. That's an H4 imbalance. This is an H1 imbalance as well. So overall, what we want to understand here is we want transactability. So here we do want to see a candle body close, a close of this bearish candle and potentially an open. That means that we've transacted here. That's great. If we can transact here, that's very, very nice. So that's cool. Other than that, right, what we know is here we actually want the opposite. When it's just highs and lows, we actually want to see price not transact at these levels because then price goes higher. right? Here we want to see a potential liquidity grab actually, and price to quickly find passive liquidity, distribute market participants here, leaving pretty much the market, and then finding a quick way to go back down. So I hope that that kind of makes sense. With this form right here, we want to see price use up that array, transact in that array, and then see a reaction from that. We don't want a quick tap outside of this. It would be nice to have some sort of close here. That would mean that, boom, we've used up the volume. We're not missing out on anything, because the quicker we just do love taps here, the more likely we actually need to revisit that. So yeah, that's kind of how we're looking at it. In this case, when it's highs and lows, so this is a most recent high, right? In that case, there's no array here. We want to see price just kind of dip above and below. So that means that price has distributed this move here. Buyers have stepped out, and then we just want to go with the flow into that open array that is there. And that is pretty much the first big technical difference that I can give you, the first big technical tool that I can give you for you to best understand all of these concepts. So I hope that that makes sense. It's a small, quick video. But tomorrow and throughout next week, we're going to go breaking this down. You can see how there's a thin threaded line between theory, more technical stuff, adding variables, adding a little bit of juice here and there, looking at the things that you could look at, and then slowly you're going to realize that this is all fractal. We're going to be breaking it down, and from there, we're going to be going into each different model, scenarios, case studies, and whatnot. Have a good one, and I'll see you in the next.